For TraderInsight.com, I'm Adrian Manns, and it's time for your daily dose of the doctor. I just got off the phone with one of you. We were talking about how to set the entries, the stops, and the targets on the Baltimore chops, and what is the meaning of that volume by price data that I've got displayed out on the right side of my chart. So let's take a quick look at this, see if we can add a little bit of color to the conversation if you're the person I talk to. And if you're not the person I talk to, it's probably a good idea to listen to this anyways. When we have the 2 standard deviation opening gap, it comes down on RHI. This is Robert Half International. We're looking at a 5-minute chart. And on the 5-minute chart, we're timing the entry based on the deepest pullback bar, which would be the third bar of trading over here. But since it's so close to the high of that second bar, let's just say we're looking for that violation, 35.37, to get us long on this trade. Now, if you're using the bar prior to the entry bar, right? In this case, this fourth bar would be the entry bar on the trade. Then your stop would be right down below the low of the third bar, $35.13. That's a pretty tight stop, and you got lucky in this case and it didn't hit it, went in your favor immediately. That's one school of thought on these. The other school of thought would be to go down to where something significant happened and was accompanied by volume, which would be right in here, and then to say 34.95 would be the stop. So it's the difference between having a 42-cent stop and having a 24-cent stop, but that's only part of the picture. So the conversation we had, I said the thing you need to do is always manage your reward to risk, and on these Baltimore chop setups, you want to make sure that your reward is significantly more than your risk. And once again, how do you pick a level to place your exit? Well, the place you'd like to see this goes up to this high, and 36.75, the open, is where a lot of stuff happened, and in fact the stock did manage to hit that over the course of the day. But if you're looking at these as shorter term trades, where do you target? So you could go in and say, I'm looking for a 50% retracement of this first bar of trading, right? And that would get us up into about here at $35.97. Or you could do a combination of things and say, in this range of the first bar of trading, something must have happened. There was a lot of volume here somewhere. And if I'm coming up from underneath and I run into the area of this bar that there was a lot of volume, what am I expecting to see happen? Well, I'm expecting to see price back off again, unless all of the selling that was going to happen there was already done. Well, in this case, we've got right about at that 50% retracement level, we do have a bunch of volume going off, and we see that at 36.06, we can draw a fairly logical line for a test. If it pokes up through there and keeps running, then we know that this volume is out of the way, and if it gets up there and then has trouble or reverses, then we know that there's still some sellers there, and that's in fact what happened. We see that it reversed and came back down again. So 36.06 as sort of a first target or a soft target made sense. Even if it did come back down on us, it reversed and went back up and tried again. That tends to be the case. And a 36.06 profit target represents a 69-cent target. And in the worst case scenario, where we had the widest stop set, that was a 42-cent stop. So it makes for a decent trade. On the tighter stop, of course, it's even better. That all has to do with whether or not you're comfortable getting into the market and getting right back out again and taking those small losses. As I said, logical stop, 34.95. Bar-based stop, 35.13. And again, just remember, the only problem with basing your stops and targets on time compressions is that if we were using 3-minute bars or 1-minute bars or 7-minute bars or 10-minute bars, your stops would be different, your targets would be different. And that's why I like to see this confluence of where did something happen, how much happened at that level by volume. And when you put all these factors together and you've got a confluence of all these indications happening at the same place, it makes for a much better setup. We'll be talking about all this stuff at our webinar this Saturday, October 29th, 2016. If you have a chance to join us, it is free, and we'll be talking about these trades and a bunch more of the first hour setups. It starts at 7 a.m. Pacific time, and I will be presenting, as will Tim Bigham. Tim's going to talk all about his option strategies and what he's doing with all this geopolitical volatility and how that's affecting his trading and what he's looking at. I'll be doing the same on the equity side. Click on the link, and you will be given the opportunity to register for the webinar. Then join us or watch the recording at any time that is convenient for you. So I hope that addresses some common questions that people might have. If you have any others, send them to me at adrian@traderinsight.com. I hope you had a great trading day today and an even better one on deck for tomorrow. The best trader education anywhere, only from traderinsight.com.